Markets are hanging off every word from the world's leading central bankers, even when they're all saying the same thing.
Inflation has fallen a long way.
There's still some distance to go.
It will depend on the path of the economy.
We clearly need more evidence.
So too does the Reserve Bank. The governor saying the battle with inflation is not over.
The war isn't yet won. So we continue to be vigilant.
For the third time, the RBA has left interest rates on hold at 4.35%. But this time it's backed away from previous threats to raise rates.
We're not ruling anything in and we're not ruling anything out.
This gives homeowners and small businesses some of the certainty that they need and deserve in difficult times.
Now, jobs are the new front line on the economic battleground.
What level does the unemployment rate need to reach to concern the Reserve Bank, and have you considering interest rate cuts?
I think the unemployment rate is something that is mechanically going to rise as the economy slows.
So no comment from the RBA about a couple of months of really bad jobs figures?
No, not any real acknowledgement of that at this stage. They still regard the labour market as overall fairly tight. And again, their own forecasts have the unemployment rate going up even further from where it is today.
This is why Thursday's labour market data for February is going to be really important. If we do see a real bounce back in employment, that suggests that actually the labour market is only easing gradually and they'll need to keep rates where they are for some time.
But the economy is slowing. Real incomes are under pressure, household spending's falling, and there are concerns about the health of Australia's biggest trading partner, China. But the RBA governor still thinks we can dodge a recession.
I still firmly believe that we are on the narrow path, and that's what the board is focusing on.
Economists say the RBA has softened its language away from rate hikes.
I'd characterise that as a gradual move to a more neutral bias, more toward potentially cutting rates later this year.
There is a risk that the RBA has to wait until 2025 before they start cutting rates, but our central scenario is November this year.
In line with the Reserve Bank's changing language, there was a subtle shift in market pricing, with the first rate cut now fully priced in by August instead of September, and 2 rate cuts expected by the end of the year.
We do think that households are going through the toughest period right now, and the RBA is aware of this as well.
But relief is on the way. Real wages are starting to rise and the taxman will be taking a smaller cut from July 1. There was some more welcome news as the energy regulator recommended a small cut to power prices.
I think an easing in energy prices, even if it's just a stabilisation, it's not increasing anymore, I think that's really positive for the inflation outlook, and so I think that's good news.
In more ways than one, if it means the Reserve Bank can cut interest rates sooner.
Michael Yanda there. Well, it's taken 17 years, but the Bank of Japan has finally raised rates and moved on from its policy of negative interest rates, which had been in place since 2016. The policy had been intended to stimulate growth in the weak economy, which has been in and out of recession. I spoke to NAB's Head of FX Strategy and Markets, Ray Attrill.
Hi Ray. The Bank of Japan hasn't raised rates since before the invention of the iPhone. Why is now a good time for it to do so?
Well, it's certainly been a long time coming. 2016, the Bank of Japan has had a negative policy rate, and this era of super low interest rates or negative interest rates in Japan dates really back to the when Shinzo Abe became Prime Minister, and there was a determination between the government and the Bank of Japan to finally get rid of the deflation curse, if that's what you want to call it. But the reason that they've acted at the time that they have is because the latest information on wage negotiations in Japan, which actually concluded just last Friday, have given a very positive indication that certainly amongst a lot of the large employers in Japan, so the Toyotas of the world, for example, they've secured pay rises of north of 5%. And the Bank of Japan has been saying, almost ad nausea, that a key condition for achieving their 2% inflation target on a sustainable basis is that wages have to be growing at least as fast as that, and ideally a lot faster. So the fact that the indications are that for the first time in decades, wages growth in the Japanese economy looks to be sufficiently high for the Bank of Japan to be confident that inflation can stay above 2%, is the reason I think that they've acted at today's meeting.
And so what will a move to a positive interest rate environment, even though it must be said, still just at 0%, what will it mean for locals? Are they ready for this?
Well, I think that there is a view that that sort of the deflation era and negative interest rates is actually politically unpopular. Certainly the Japanese yen has been very weak, which hasn't been a source of popularity. It means that for Japanese travelling abroad, the rest of the world seems pretty expensive. It's also been adding to import prices. So a lot of the things that Japan imports from the rest of the world, particularly energy and food, have been more expensive as a result of the weak yen. But in terms of what it actually means, the fact that interest rates have gone from minus 0.1% to barely above zero isn't going to mean a whole lot as far as, say, financial markets are concerned and what it means for the value of the Japanese yen. That's going to require far more substantial increases in interest rates than we've seen today. And there's no indication at this stage that the Bank of Japan is minded to continue ratcheting rates higher. And unless or until that happens, then the sort of the broader implications in terms of sort of financial markets and what it means for the Japanese yen, frankly, is not very much at all.
Ray, we know Japan's stock market has been booming in part because of stimulus from the government, but also as a result of Western investors moving their money from China. Is there real hope of economic growth on the horizon?
Yes, I think so. Although technically Japan, while it got close to a recession in the second half of last year, we actually had some GDP growth numbers last week that actually were revised up for the fourth quarter. So actually they've revised away their technical recession. And if you X that out, actually the last couple of years, Japan has been enjoying pretty good growth, and the weakness of the yen has been part of that. You know, and the weak yen has also been a real stimulant for the stock market, which in turn does reflect optimism that Japan is getting out of this sort of deflationary funk that it's been in for over a decade now. So I think there are some realistic prospects. Obviously, you know, the outlook for the global economy is not that great, but certainly Japan seems to be holding its own just at the moment, and in fact has been one of the better performing major economies in the last couple of years.
How quickly do you see the Bank of Japan making the next move, and what will it be looking at before it hikes again?
Well, I mentioned the wages data that we had last Friday that has been the catalyst, if you like, for the move. But those wage increases only cover about 15 to 17% of the Japanese workforce. There are a lot of wage negotiations still ahead, particularly amongst small and medium-sized enterprises that actually employ the bulk of people in Japan. Those wage negotiations won't conclude until sometime in June or early July. So I think if the message out of there is a satisfactory one in terms of wages growth, say, being well north of 4%, that could be the catalyst for another move from the Bank of Japan, possibly in July, which will be a meeting where they will produce new forecasts, and maybe there'll be one or two more before the end of the year. But at this stage, financial markets, and I have to say we agree with them, aren't thinking that this Japanese policy rate that, say, has gone positive for the first time in 7 or 8 years today is going to be any higher than about 0.2 or 0.3%. So still a big contrast with the rest of the world, even though some central banks, particularly in Europe and the United States, look like they're pretty close to starting to cut interest rates.
What does this mean for countries that trade with Japan?
Well, it'll be interesting to see, particularly with China. Obviously, China and Japan compete aggressively in third markets, particularly for things like electronics and exports. Think of cars in particular, and the growth of EVs, for example. So the exchange rate between China and Japan is very important, with the Japanese yen having been so weak because of this ultra-easy Bank of Japan policy. It has put Japan at a competitive advantage in a lot of these export markets, one of the reasons that the export sector has been doing as well as it has. So whether or not the Japanese yen strengthens from here is going to be important, because if it does, it means that other countries that Japan competes with, particularly China, but others throughout the Asian region, may be more inclined to allow allow their currencies to strengthen. And there will, incidentally, be some positive feedback to Australia and the Australian dollar were that to eventuate. But as I say, the risk is that if the BOJ remains extremely gradual in its approach to normalising policy, then it may be quite some time before that Japanese yen really starts to strengthen.
So it is likely to remain a popular destination for Australian travellers for at least a while yet.
Yes, I think so. That Aussie yen exchange rate is still very close to 100, so Japan is still one of the most attractive destinations for outbound tourism for Australia, and I think that remains the case for some time to come.
Ray Attrill, thank you.
Thanks, Kirsten.